Hello everyone, and welcome back to our channel. Today, we're going to talk about one of the most important and complex topics in economics, inflation. So, what is inflation, and what causes it? Let's dive in. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, the purchasing power of currency is decreasing. In simpler terms, it means that the same amount of money can buy fewer goods and services over time. And the most common cause of inflation is an increase in the supply of money in an economy, which can happen in a variety of ways. The first and most obvious way that the money supply can increase is through government spending. Government spending can be a significant driver of inflation because it increases the amount of money in circulation in an economy. When the government spends money, it injects cash into the economy, and that money can be used to purchase goods and services. This increase in demand for goods and services can drive up prices if the supply of goods and services does not increase at the same rate. The government can spend money on a variety of things, including infrastructure projects, education, healthcare, and defense. Each of these areas of spending can have a different impact on the money supply and inflation. For example, if the government spends money on infrastructure projects like building highways, bridges, and airports, it can create jobs and stimulate economic growth. The people who are employed by these projects will have more money to spend, which can increase demand for goods and services. If the supply of goods and services doesn't increase at the same rate, then prices can go up. Similarly, if the government spends money on education and healthcare, it can create jobs and stimulate economic growth. People who work in these industries will have more money to spend, which can increase demand for goods and services. Again, if the supply of goods and services doesn't increase at the same rate, then prices can go up. Defense spending can also increase the money supply and lead to inflation. When the government spends money on defense, it typically purchases goods and services from private companies, such as weapons manufacturers. This spending can increase demand for goods and services, which can drive up prices. Additionally, defense spending can also lead to inflation indirectly by crowding out other forms of spending, such as education and healthcare, which can lead to supply constraints and price increases. However, it's important to note that not all government spending will necessarily lead to inflation. If the government spends money on programs that increase the supply of goods and services, such as research and development or investments in green technology, it can stimulate economic growth without driving up prices. Another way that the money supply can increase is through central bank policy. Central bank policy is one of the most important factors affecting the money supply and can have a significant impact on the economy's overall health and stability. Central banks, such as the Federal Reserve in the United States, the European Central Bank in Europe, and the Bank of Japan in Japan, have the power to influence the money supply through their monetary policy decisions. The central bank can increase the money supply by lowering interest rates, or by buying government securities in the open market. When the central bank lowers interest rates, it makes it easier for banks to borrow money, which increases the amount of money in circulation. Banks are then able to lend more money to businesses and consumers, which can stimulate economic growth and boost inflation. The central bank can also buy government securities in the open market, which increases the money supply by injecting more money into the economy. When the central bank buys government securities, it does so with newly created money, which then becomes part of the money supply. This process is known as quantitative easing, and is often used to combat recessions or stimulate economic growth. However, increasing the money supply through central bank policy can have consequences. One of the most significant risks is inflation. If the central bank increases the money supply too quickly, it can lead to an oversupply of money in the economy, which can cause prices to rise. Inflation can lead to a decrease in the purchasing power of money, making it more expensive for consumers to purchase goods and services. Additionally, increasing the money supply can lead to asset bubbles, where asset prices rise to unsustainable levels. This can happen when investors use the newly created money to purchase assets such as stocks, bonds, or real estate, leading to a rapid increase in prices. However, if these prices are not supported by the underlying fundamentals of the economy, such as earnings or economic growth, then they may be unsustainable and lead to a market crash. A third way that the money supply can increase is through international trade. International trade refers to the exchange of goods and services between countries. When a country exports more goods and services than it imports, it generates a surplus of foreign currency. The country's central bank then buys that foreign currency with domestic currency, increasing the money supply. Let's take an example to illustrate this. Suppose that country A exports $1 billion worth of goods and services to country B, but only imports $500 million worth of goods and services from country B. This means that there is a $500 million surplus of foreign currency in country A, in this case, the currency of country B. The central bank of country A can then use its own currency to buy that $500 million surplus of foreign currency. This increases the amount of currency in circulation in country A, which can lead to inflation if the amount of goods and services available for purchase doesn't increase at the same rate. Now, you might be wondering why the central bank of country A would want to increase the money supply in the first place. One reason is to keep the exchange rate stable. When a country has a surplus of foreign currency, the value of its domestic currency may appreciate, making its exports more expensive and less competitive in the global market. By buying the surplus of foreign currency, the central bank can keep the exchange rate from appreciating too much. Another reason why the central bank might want to increase the money supply is to stimulate economic growth. By injecting more money into the economy, it can increase demand for goods and services, which can lead to job creation and higher economic activity. However, if the economy starts to overheat and demand outstrips supply, it can lead to inflation. Now, the opposite can also happen, and a decrease in the money supply can cause deflation, which is the opposite of inflation, where prices are falling. Deflation is the opposite of inflation, and refers to the general decrease in the level of prices of goods and services in an economy. In other words, it means that the same amount of money can buy more goods and services over time. Deflation can occur due to a decrease in the supply of money in an economy, or a decrease in demand for goods and services. When the supply of money decreases, it leads to a decrease in spending power, and people are less willing to spend money. This decrease in spending power leads to a decrease in demand for goods and services, which results in a decrease in their prices. Furthermore, when the money supply decreases, interest rates usually increase, and borrowing becomes more expensive. This decrease in borrowing leads to a decrease in spending and investment, which further decreases the demand for goods and services. Deflation can be caused by several factors. One of the primary causes is a decrease in the money supply, which can occur due to central bank policies or a decrease in government spending. Another factor that can cause deflation is a decrease in demand for goods and services due to a decrease in consumer confidence or a decrease in the population's purchasing power. Deflation can have both positive and negative effects on the economy. On the positive side, falling prices can lead to an increase in the purchasing power of consumers, and lower prices can lead to higher consumer spending. Additionally, deflation can lead to a decrease in interest rates, making it easier for individuals and businesses to borrow money. However, deflation can also have negative consequences. A prolonged period of deflation can lead to a decrease in economic growth as businesses see their profits fall and are less likely to invest and expand. Deflation can also lead to an increase in the real value of debts as the money borrowed becomes more expensive to pay back over time. This can cause a decrease in borrowing and further decrease economic activity. In conclusion, inflation is a complex topic that can be caused by a variety of factors, including government spending, central bank policy, and international trade. It's essential to understand the causes of inflation to make informed decisions about investments and financial planning. Thanks for watching, and we'll see you in the next video.